Hi, my name is Amar, and welcome to Conversations with Kyle. Kyle is a CPA, and today we are going to talk about post-divorce tax planning. What are your thoughts, Kyle?
Is it Amar's favorite topic, right?
There you
go. No, it's just it comes up every so often. Obviously there's a lot of emotions usually running high, and maybe not everything's logical. That somebody wants in terms of dividing up assets and who gets to claim the kids and estimated tax payments and what, like I said, what assets to divide. Is married filing separate an option? Should they get divorced this year? Should they get divorced next year? Do they care? Considerations like that.
So let's go through some of these. So changing in filing status. So like if your divorce is not final yet, you're in that gray period. What are the final rules, or how do you file taxes?
Yeah, and so your marriage status with the IRS is whatever your status was on December 31st of that tax year. So if you get divorced on December 30th, you're filing either head of household or single that year. If you get married on December 30th, you get married filing joint for the entire year. There's no proration. There's no, portion of it's single, portion of it's married. It's a bright line test, one or the other. And so, I think it just depends on your tax situation. There's actually a small number of people that, I don't know if anybody's heard of the quote unquote marriage penalty, but if you have two taxpayers making about 150 to 300, there's kind of a zone in there where you're actually penalized for filing joint versus single.
You're saying 150 to 300 combined, or each person?
Each person. And yeah, those are rough numbers, and it just depends on your deductions and your capital gains and, a bunch of different things going on when you get to that income level. But there's also the other dynamic of filing joint is if one spouse has a lot of income and one maybe stays at home or doesn't generate income, the person that's making, generating income it's much more beneficial for them to file joint because they hit the higher income brackets much later, and it kind of evens out, right? And so, I had a client with a huge capital gain, sold his company, was going, through a divorce, and, maybe I shouldn't say this, but he more or less hung on to, get the lower capital gains rates, and then they got divorced in January. So we had a little bit of tax planning to do there, and I think just monitoring when the date hits that you get divorced and how to navigate that.
Yeah, and then I guess not only the timing of it, but the division of property, right? So there's a large piece of most people that we work with is they have a house. There's probably mortgage interest. There's real estate taxes. How does that play into all this?
Yeah, so just like anything else, the type of asset that you own, obviously can carry vastly different tax impacts, either when you sell it or when you gift it, or, there's a lot of different things, and we can't get into every single one today, but
yeah.
And also you just kind of have to be almost kind of perspective on what you think might gain in value or what might has a risk of losing value. And, you could divide everything up perfectly 50-50 today in terms of current fair market value. And then that could be wildly different in 2 or 3, 4 or 5 years. And so,
yeah, and I think a lot of people have seen that too, right? And then there's maybe some resentment or some feelings of things were not divided equally, right? Like,
yeah.
And that in the startup world, startup stock and all that is part of that process.
Yeah, and the more of these that I've worked through, I've just come to realize there is no way you can get it absolutely perfect and completely even Steven 50-50. You can get close, but there's always going to be some advantage or disadvantage to one spouse or the other.
So let's say you have some couple of children. Who gets to claim them as a dependent, or who gets to the child care credits?
Yeah, so more often than not, that's usually divided. That's during the divorce agreement. In the divorce agreement, it'll say who can claim the kids. Usually it's every other year, or maybe it's, one spouse gets all of them every year. But yeah, generally speaking, the person with lower income on their tax return is going to get more of a benefit for children, claiming them as a dependent. So I think once you get above 430,000 of income, you pretty much get completely phased out of all the dependent care benefits, all the child tax credits, everything. So, there's literally no benefit for claiming your kids other than spite, which I've come across before. And there's definitely some planning there in terms of who gets the greater benefit, and would you rather keep the money in the family or give it to the IRS, or do you care? Or just depends.
Yeah. I guess, children in this example, we're talking about the deductions and the tax credits, but there's also the opposite side, which is income and estimated tax payments that you have to make. Is it a percentage? Is it, how does that work? And I guess that one specifically, it's probably state dependent as well.
Yeah. And so, while you're married, the actions of one spouse are still your responsibility for the most part, until you get officially divorced. So, and it's always a hot button issue in terms of, how much tax did this person's income generate? And can we go back perfectly and say, these number of deductions are allocated to you, this amount of income is yours, this is the tax it generated. Because, we have graduated tax rates. So the first income gets a lot less than the later income. So how do you calculate that? And is it a prorated rate, or, there's no perfect answer there. And so that's definitely something you want to sort out in the divorce agreement, in terms of method of payment and who's responsible for those until you're officially divorced.
Yeah. So not only do you need somebody that's good at having the conversation to kind of figure out what's fair, but also, working with professionals like Kyle and myself, that, gives you a sounding board to make better financial decisions for yourself, just not going through the divorce, but more long-term as well. And so if you have any questions or concerns, please reach out to us. We like to keep this conversation, so please put comments down below, like, subscribe, all the stuff that makes YouTube love us. Right, Kyle?
That's right. Yeah.
And we look forward to talking to you guys in the next week. Thanks.
Appreciate it, Amar. Thanks again. We'll talk soon.
Bye.